We have had a nice turn in the market today. Certainly the Dow, the S&P, they are both positive. NASDAQ, though, playing to the theme that we're talking about today, is in the red. The Russell is leading the way once again. As we said, the early year story has been the performance of things other than the mega caps and the NASDAQ. Financials, industrials, and as we said, the small caps. The Russell hitting a new all-time high this morning. It's up almost 4% to start this year, and we find it interesting today that Bill Baruch is trimming his position in it. Why?
Well, we own the IJR. It's a more concentrated small cap ETF than say the Russell 2000, and we actually doubled our exposure in that in Q4. We went from a 2% holding to more than a 4% holding. We looked for some follow through. Now the IWM really accelerated and outperformed the IJR. Although over the last 5 years or so, the IJR outperformed the IWM more significantly, and I'm a little disappointed that we're not getting that move. Now what we're looking at here is we trimmed it down more of a rebalancing, bringing that back closer to a 4.25% from nearly 5. And what it's doing is raising a little cash for us because remember, there is going to be some news tomorrow. There is going to be with jobs and Supreme Court rulings. But as you look in the year, I think really the important thing is this is going to be the first quarter. You need to make your money in the first quarter. I think the year could really level out from April to November, and there's a little bit of a seasonal lull in the middle of January. So what we're doing is we're raising a little cash and some rebalancing, taking a little bit off the table here in small caps, seeing if that actually gets the breakout, maybe lean into it more.
Isn't it already getting the breakout? I mean, the follow-through that you were allegedly looking for at the end of the year into the new one is happening, is it not? And
not in IJR. Well, IJR has not made a new record high yet, so I'm ill positioned. So I want to look at where I can put that cash. If I raise about 60 basis points or so,
I mean IJR is up 4% year to date. We
yes,
have like 4 days.
And we've picked up from that ad in Q4. We picked up 4 to 5%, and so that's what we're taking a little off the table, a little rebalancing. But it gives us that flexibility, and you want to have flexibility. If you're sitting there fully invested and you get a little bit of a knockdown or the market moves a bit, you can't be active. You can't do anything else. So what we're looking at here is we're trying to find some places, rebalance, raise a little bit of cash, and if we get that breakout in IJR, maybe I'll lean back into that. But I think there's better places. IWM is more clean right now of a breakout. You're getting more materials. You're getting those biotechs that are driving it as well, where IJR doesn't have that. IJR has a little better balance sheet than IWM.
What do you make of the complexion of this market so far this year?
Oh, I love it so much, to be honest. It's nice to finally have stocks that are in favor. I really have been enjoying the rotation that I've been seeing and seeing it broaden out a little bit, and it makes sense to me. And my thoughts were last year that the winners of the last couple of years should take a pause. I don't think their valuations in general were so rich that they deserve to have a major decline, but I think that they deserve to have a consolidation. And I looked at the last couple of years as all the money just got soaked up into a small portion of stocks, and there's other companies out there, like the ones in our disciplined growth strategy, like the ones in our equity income strategy, that just sat fallow. Meanwhile, they had really compelling valuations, like perfectly great earnings growth. So I like it. It just seems like reasonability is coming into the market. Rick Reeder put a piece out yesterday, and I thought the headline was really interesting. He said, odds are changing. 2026 is a market for investors, not gamblers. And I read the article, and what he's really fleshing out in there is that you have to do the work this year. You have to think about valuations. You can't just jump on the winning trade. So it seems like it's working. But one thing on the small cap that I just think is interesting, and this is something I was struggling with as I was writing our quarterly letter yesterday. I was saying, but small cap, the Russell 2000 was up 12%. But the other one, right, the S&P 500 is up 6%. So as Bill's fleshing that out, I think even going into this year and seeing differences in two indexes that superficially sound the same.
It's banks versus biotechs. The small cap 600, you have to be profitable to be in the index. As a result, it's a higher concentration of some of those older industrials with profits and obviously financials. The Russell 2000 is a junkier index. It's got a lot more of the non-profitable biotech, a lot more of the non-profitable tech, some of the more startup-y type companies. It's really just a reflection of whether or not you're in a high-risk appetite or or a lower risk appetite market, which one will outperform the other over very long stretches of time, they end up meeting up.
And it feeds in exactly to the Rick Reader comment, which is, again, to me saying basically, you've got to do your homework. You can't just say, hey, small cap was up 12%.
You should, right. If you're investing in small cap, you should know the difference between those two indices.
But if you're investing in period, you can't just say, I want to own small cap and choose any old index. You have to do the work and know that there's a difference.
What are we in now? Are we in a higher risk or a lower risk market?
Okay, I love Alpha Jenny. I am here for it. Like this, the season of Alpha Jenny is upon us. But I really want to make this clear to people because I don't think they understand. Just because all of the focus and the attention has been on the AI build-out and the data center story for the last year doesn't mean that what's going on right now is anything new. In fact, the peak of the Mag 7 versus S&P 493 outperformance was over a year ago. That outperformance peaked in December of 2024. 25 was a very mixed year for the Mag 7, and as a group, they did not materially do better than the S&P 500, and now you see that following through this year. Super bullish for stocks. Just looking at an interesting data point that we've been looking at, every single sector positive except tech today. We've only had 10 other days since 1990 where every other sector was positive and tech was down. Tech was down almost 2% on the day at its low. There's no news. There's no earnings. The only thing driving this is people looking at their portfolio and saying, wow, you know what? There really are other games in town. Financials, industrials, there are other things I could be doing. The other thing I would point out here, and I think this is really important, if you actually look at this as a horse race in terms of like, do I have a barbell in my portfolio? Yes, I love Apple, I love Microsoft, blah, 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 but do I have enough on the other side of the barbell? Most investors would have to conclude, no, I actually don't. And I think that that is what's driving the rally, not just today, but this is a rally that's been building since September, October in these quote unquote other stocks.